They just broke the price of silver. Because right now the world is showing you two numbers at the same time, and both of them are real. On one screen, the spot price is sitting around $71 an ounce. But out in real physical markets where people actually hand over cash and metal, silver is already trading in triple digits. In Japan, listings on Mercari are showing around $130 an ounce. In Kuwait and China, the talk is already 100 to 106. That's not a normal gap. That's a pricing system splitting in half. And here's why you should care. Silver isn't just a shiny asset. It's a key industrial material. When the pricing mechanism fractures like this, it doesn't stay in the metals world. It spreads into manufacturing, supply chains, and financial confidence. Now watch how fast this escalates, because the real story isn't silver is rising, it's who can't deliver it anymore. This story starts with a simple claim: silver is $71 an ounce. But the moment you test that claim in the real world, it falls apart. Because a normal market has one job. It's supposed to produce one shared price that everyone trusts. And when that trust is intact, it doesn't matter whether you're in New York, Tokyo, Kuwait, or Shanghai. The numbers might wiggle a little, but they don't break into two separate realities. Yet that's exactly what's happening here. You have an official-looking price on the Western screens, and then you have the physical reality where people are paying over $100 an ounce, $130 in Japan, over $100 in Kuwait and China. That's not speculation. That's people trying to get metal in hand right now. So here's the question that changes everything. If silver is really $71, why is nobody willing to sell it to you for $71? Here's the strongest signal that something is wrong. A price only matters if it can clear the market. If buyers show up, sellers show up, and the trade happens. Clean, fast, predictable. But in your sample, we're seeing something else. We're seeing silver priced one way in the paper world and a completely different way in the physical world. And the numbers aren't close, 71 on the screen. 100 to 130 where real metal is moving. That's not a premium, that's a warning. Because when physical silver is trading at $130 in Japan, it means the market is screaming one thing: supply is not meeting demand at the posted price. People are bidding higher because they're not chasing a chart. They're chasing availability. Notice what's missing here. You don't see the official pricing system instantly correcting. You don't see the gap closing on its own. Instead, the gap holds and even widens like two different planets orbiting the same metal. And once a market shows you two realities at once, the next step is always the same. Someone gets exposed. Now watch how fast this turns from a weird silver story into something much bigger. Because this isn't the first time a market has tried to pretend there's plenty of supply while the real world quietly runs dry. When systems are stable, price discovery is honest. A shortage shows up as higher prices, a surplus shows up as lower prices. Everyone adjusts and life moves on. But when the system is under pressure, the market does something else. It tries to hold the official price down, even as the real cost of getting the product rises behind the scenes. That's when you get distortions, delays, sudden premiums, and eventually panic buying. And the scariest part is how quickly people normalize it. At first it's just a little premium. Then it becomes, well, physical is always higher. Then one day you wake up and physical is $30, $40, $50 higher than the screen price, and everyone acts like that's fine. But it's not fine. It's a market signal telling you the price you're being shown is no longer the price that clears reality. And once a system starts living on two prices, it usually ends with one event that forces the truth out. Here's the disturbing part. The gap itself is not the story. The story is what the gap implies. Because you don't get $130 silver listings in Japan unless someone believes silver at 71 is basically a mirage, not a bargain, a mirage. And once that belief spreads, the entire psychology flips. People stop asking, is silver cheap? And start asking, can I even get it? That's the moment a commodity stops behaving like an asset and starts behaving like a survival item. Look at the contradiction that's forming. On paper, silver is still being priced as if supply is available, as if the market is calm, as if everything is normal. But in physical markets, the behavior is different. Real buyers are paying triple digits because they're reacting to scarcity, delays, or fear of future unavailability. They're not buying for a small gain, they're buying because they don't trust the system to deliver later. And here's why that permanently changes how you see it. The price isn't what you see on a screen. The price is what it costs to take it out of the system. And then the story gets even tighter, because this isn't just one place, one platform, one random spike. It's multiple locations, multiple markets, multiple signals pointing in the same direction at the same time. Japan showing 130 per ounce, Kuwait and China showing around 100 and above. The official spot price still sitting far below. That's the kind of pressure pattern you see right before a market turns unstable. One zone starts bidding up, another zone follows, and suddenly the global price isn't global anymore. It's regional survival pricing. Whoever is desperate pays more. Whoever has inventory holds back. This is where the story flips. Because once physical demand starts pulling metal out faster than the system expected, everything speeds up. Premiums rise, sellers become selective, buyers stop negotiating. They just click buy before it disappears. And every time someone pays triple digits while the screen still says 71, it creates the most dangerous force in markets. Proof that the screen price is beatable. That triggers one thing: more buyers. And that's why the question isn't what happens if this continues. The real question is what happens when it spreads. Now bring this down to your world, because if silver really has split into two prices, paper price and physical price, that doesn't stay trapped inside a commodity chart. It leaks into real life fast. It hits anyone who needs the physical material, not the financial headline. It hits manufacturers who suddenly can't source inputs at the official number they budgeted for. It hits suppliers who stop quoting firm prices because they don't know what replacement inventory will cost next week. And it hits consumers when the final product quietly creeps up in price, not because someone raised a sticker, but because the raw material underneath it is no longer stable. And here's the part most people miss. This kind of fracture doesn't feel like a dramatic crash at first. It feels like small disruptions, back orders, limited stock, premium surcharges, a seller suddenly saying, "We can't promise delivery." That's how shortages arrive in modern systems. Not with alarms, with delays. So if you've ever tried to buy something and thought, why is it more expensive in real life than it is online? If this feels familiar, say so in the comments. Because this is bigger than silver. It's the first crack in trust. Here's the mechanism that makes this possible. It's not just people want silver, it's that the system has two different worlds running at once. One world is paper, screens, spot prices, a number that can move without a single ounce physically changing hands. The other world is physical, inventory, delivery. The moment somebody asks, can you actually ship it? And when the physical world starts pulling away, the paper world can keep smiling until someone forces a delivery test it can't pass. That's why this story is so unsettling. Because the spot price feels like a fact. It feels official. It feels objective. But in reality, it's only powerful as long as people accept it as truth. Once enough buyers decide the truth is availability, not the screen, the whole system reprices through behavior, not announcements. And the incentives are brutal. If you hold physical metal and you believe supply is tightening, you don't rush to sell. You wait. You let the desperation come to you. You let the premium rise. And every day you wait, the buyer anxiety gets worse. Notice what they didn't solve here. They didn't close the gap. They just learned to live inside it. And that's how fragile systems fail. Now here's where the next move starts forming. Because once a market fractures like this, There are only two paths forward, and both of them change everything. Path one is the quiet correction. The official price finally catches up. The spread compresses. 71 climbs toward the real world triple digits, and everyone pretends it was just a temporary premium. But the damage is already done, because the world has learned the posted price wasn't the real price. Path 2 is the ugly break. Physical supply stays tight. Premiums get worse. The people who can't source it start bidding higher in panic, and the gap doesn't close. It becomes the new normal, where the screen price is just a reference point and the real price is whatever it takes to get silver in hand. And the scariest part, neither path requires a dramatic headline to kick off. It just requires time, pressure, and more people noticing what's happening in Japan, Kuwait, and China, while the Western screens still flash 71 like nothing is wrong. So don't watch the price, watch the behavior, because the next stage of this story won't start with an announcement. It'll start with someone failing to deliver. So here's the clean takeaway. When you see one asset trading at two prices, it's not a market quirk. It's a warning that trust is leaving the system. The official number says silver is $71 an ounce, but real listings and real buyers are already showing triple digits. 100, 106, 130. That means the world is quietly voting with money, not with headlines. And once that vote spreads, everything changes. Because the most dangerous moment in any market is the moment people stop believing the price and start believing the shortage. That's when normal buying turns into urgent buying. That's when I'll wait turns into I need it now. And that's when a metal stops being a commodity and starts becoming a signal of something larger breaking underneath. If you want the next layer of this story, what happens when a pricing system can't hold reality down anymore? Make sure you're subscribed, because this wasn't the silver story, this was the trust story. And the next chapter is already moving.